Ever stared at a stock chart, maybe a crypto price, and just felt completely lost?
Right.
Like you're trying to figure out where it's going next, but it's all just noise.
Oh, absolutely. That feeling of just being swamped by all the ups and downs, the daily zigzags, it's really
Mhm.
common. Hard to see the real direction sometimes.
Exactly. Well, what if I told you there's a tool, actually a pretty common one, that can help smooth all that out, sort of cut through the static?
Ah, you must be talking about moving averages.
You got it. Today on the deep dive, we're looking at moving averages. Think of it as a beginner-friendly way to, get a clearer picture of the trend.
Right. And we're drawing on some material that's really aimed at newcomers, breaking down two key types: the simple moving average, that's SMA, and the exponential moving average, or EMA.
So our mission today is pretty straightforward. Really get what SMAs and EMAs are, figure out why traders use them so much, and nail down the main differences. We want you to walk away with a clear, jargon-free understanding you can, well, maybe even use.
Sounds good. Ready to dive in.
Let's do it. So first things first.
Mhm.
What is a moving average, fundamentally?
Okay, so in simple terms, a moving average helps you see the underlying trend. It does this by calculating an average price for an asset over a specific number of periods, like, say, the last 20 days.
An average over a set time. Got it.
Yeah, and as each new period, like a new day's price, comes in, the oldest price drops off, and the average gets recalculated. So this window of data is always moving, hence moving average.
Ah, okay. So it filters out the sort of random short-term jumps and dips.
Exactly. It smooths the data so the main trend is easier to spot.
That makes a lot of sense. It's kind of like averaging the temperature over a week to see if it's generally getting warmer or colder
Yeah.
instead of freaking out about one hot afternoon.
Precisely. It's that kind of smoothing effect. So let's start with the first type, the simple moving average, SMA.
Right, SMA. Symbol. Sounds promising. How does it work?
It really is simple. It just takes the closing prices for whatever you're tracking a stock, maybe over a certain number of periods you choose, say 10 days or 50 days.
Mhm.
Then it just adds them all up and divides by the number of periods. And the key thing here is every price in that period gets exactly the same importance, the same weight.
Equal weight. So the price from 10 days ago matters just as much as yesterday's price in a 10-day SMA.
Exactly right. For anyone who likes formulas, it's just SMA equals price 1 plus price 2 all the way to price n divided by n is just the number of periods you picked.
Okay, simple enough. Can we do a quick example, make it concrete?
Sure. Let's say a stock closed at $10,
Yeah.
then $12, $11, $13, and $14 over the last 5 days.
Okay, 5 days.
To get the 5-day SMA, you add them up. 10 plus 12 plus 11 plus 13 plus 14, that's $60. Divide by 5 days.
$12. So the 5-day SMA is $12.
Correct. Now, let's see how it moves. What happens the next day? Say the price closes at $15.
Ah, okay. So the window shifts. We drop the oldest price, the $10.
Exactly. Drop the $10, add the new $15. So now you're averaging 12, 11, 13, 12, $14, and $15.
Let's see. 12 plus 11, 23, plus 13, 36, plus 14, 50, plus 15, 65. So $65 divided by 5, $13.
There you go. The 5-day SMA moved up from $12 to $13 because the newer, higher price came in.
And what does this actually look like on a trading chart? I assume it's a line.
Yes, you'll see it plotted as a line, usually overlaid on the price bars. And because it's an average, it's smoother than the actual price movements.
Right.
If the price is generally trending up, the SMA line will tend to slope upwards too. If the price is falling, the SMA line will slope downwards. It just gives you that general direction.
Okay, so the big takeaway for SMA: simple calculation, equal weight to all prices in the period. Makes sense. Now, what's the deal with the other one, the EMA? Exponential moving average.
Right, EMA. It also calculates an average price over a period, but here's the twist. It gives more weight to the most recent prices.
Ah, okay, so it reacts faster to what's happening now.
Exactly.
Right.
It's designed to be more responsive to new information, to recent price changes compared to the SMA. Less lag, you could say.
Interesting. So how's that calculated? Is the formula very different?
It's a bit more involved, yeah. It's iterative. The basic idea is EMA equals current price times a smoothing factor plus the previous day's EMA times 1 minus that smoothing factor.
Whoa, okay. Smoothing factor. What's that?
The smoothing factor basically decides how much importance the latest price gets. It's calculated as 2 divided by n plus 1, where n is your chosen number of periods again.
2, n plus 1. Okay.
And just a technical note, For the very first calculation of an EMA series, you usually start by using the SMA for that period as the previous EMA value, just to get things rolling.
Right, you need a starting point.
Okay.
Let's use our example again. Prices were 10, 12, 11, 13, 14. The 5-day SMA was $12. Then the next day's price was $15. How would the EMA work out?
Okay. For a 5-day EMA, N is 5. So the smoothing factor is 2, 5 plus 1, which is 26, or about 0.333.
Okay, 0.333.
So the new EMA would be the current price, $15 times 0.333, plus the previous EMA, which will approximate with the prior SMA of $12 times 1.333.
Let's see, $15 times 0.333 is roughly $5. And $12 times 1.333, that's $12 times 0.667, roughly $8.
Right. So $5 plus $8 gives you an EMA of around $13.
Huh. So in this case, the EMA calculation gave us $13, same as our rolling SMA calculation did. Is that typical?
Ah, good catch. In our simplified rolling SMA example, we got 13. But if we were calculating the SMA without the roll initially, just the average of 12, 11, 13, 14, 15, it would also be 13. The key point is how they react over time. The EMA calculation inherently gives more weight to that $15. If the next price was, say, $10 again, the EMA would drop faster than the SMA because that newest price has more influence.
Okay, I think I get it. The EMA feels the new price more strongly. So visually on the chart, does it look different from the SMA?
It also looks like a smooth line, yes.
Yeah.
But you'll generally notice the EMA line stays closer to the actual price bars. It hugs the price action a bit more tightly than the SMA, especially when prices are moving quickly.
Because it's reacting faster to those recent changes.
Precisely. So the key feature for EMA, greater weight on recent prices, making it more sensitive, more responsive.
Okay, great. We've got a handle on what they are and how they're calculated. But why are they so fundamental? Why do traders rely on these moving averages so much?
Well, there are quite a few reasons. First off, as we've seen, they are relatively simple. Simple to understand, simple to actually put on a chart.
Right, most platforms let you just click a button, yeah.
Exactly. No complex math needed from the user's end. That accessibility is huge.
Makes sense. What else?
Second, they are really good for trend identification. That's probably their main job, just looking at the slope of the moving average line.
Upward slope, uptrend. Downward slope, downtrend.
Pretty much. And also, where the price is relative to the line, if the price is consistently staying above an upward sloping moving average, that's generally seen as confirmation of an uptrend.
And below a downward sloping one confirms a downtrend.
Correct. And if the price is just chopping back and forth across a relatively flat moving average, that often tells you the market's moving sideways, maybe consolidating, no clear trend.
Okay, so simplicity, trend ID. What else makes them popular?
Their versatility is another big one. You can use them on, well, pretty much anything that has a price chart. Stocks, Forex, crypto, commodities. Doesn't matter.
And different time frames too, right? Like short-term versus long-term.
Yes, absolutely. From like 1-minute charts for super short-term trading all the way up to weekly or monthly charts for long-term investors. They work across the board.
Is there a general preference, like SMA for long-term, EMA for short-term? I think you touched on that.
Yeah, that's a common rule of thumb. Because the SMA is smoother and less reactive, it's often preferred for looking at longer-term trends. Think the classic 50-day and 200-day SMAs on stock charts.
Okay.
Whereas the EMA, being more responsive, is often favored by shorter-term traders. Day traders, swing traders, they might use, say, a 12-day or 26-day EMA to get quicker signals.
Got it. So you mentioned signals.
Yeah.
Can these moving averages actually tell you when to, like, buy or sell?
Well, they can generate potential signals, yes. One really common strategy is looking for crossover.
Crossovers, like when two moving average lines cross each other.
Exactly. A popular bullish signal, a potential buy signal, is when a shorter-term moving average crosses above a longer-term moving average. It suggests upward momentum is building.
So maybe a 20-day MA crossing above a 50-day MA.
Precisely. And the opposite, the shorter-term MA crossing below the longer-term MA, is considered a bearish signal, a potential sell signal, suggests downward momentum.
And does that work for both SMA and EMA crossovers?
Yes, the concept applies to both. Though because the EMA reacts faster, an EMA crossover might happen a little earlier than the corresponding SMA crossover. Might.
Okay. Are there other types of signals?
Another basic one is simply when the price itself crosses a moving average. Price moving up through the MA line from below could be seen as a buy signal.
And price falling down through the MA line from above could be a sell signal.
Right. Again, these are potential signals, not guarantees.
Of course. So we have simplicity, trend ID, versatility, generating signals. What else?
Well, related to smoothing, they really help reduce market noise. Daily prices can jump around a lot based on news, emotion, whatever. MAs filter that out.
Helps you keep focus on the underlying trend, not the daily drama.
Exactly. Helps avoid emotional reactions to just, temporary blips.
That seems really valuable.
And then there's a fascinating aspect. Because certain moving averages are so widely used, they can almost become self-fulfilling prophecies.
Oh, how so?
Think about those really common ones like the 50-day and especially the 200-day SMA for stocks.
Hmm.
So many traders, funds, algorithms are watching these levels.
Right.
So when the price approaches, say, the 200-day SMA, you often see a reaction. If it holds above, buyers might step in seeing it as support. If it breaks below, sellers might pile on seeing it as resistance breaking.
Just because everyone expects a reaction there.
Partly, yes.
Yeah.
The sheer volume of orders placed around these well-known levels can actually influence the price movement. The 200-day SMA is often seen as that big line in the sand between a long-term bull or bear market for a stock.
Wow, that's a cool psychological angle.
Uh,
What else? Customization.
yes, definitely. The flexibility to choose the period length, the N in the formulas, is key. You tailor it to your trading style.
Shorter period for faster trades, longer period for long-term investing.
Exactly. A day trader might use a 9 or 10 period EMA for quick signals. A long-term investor might stick with that 200 period SMA for the big picture. Lots of flexibility there.
Makes sense. And one last point. Do they work well with other tools?
Oh, absolutely critical. They are rarely or shouldn't be used in isolation. Most traders use MAs in conjunction with other indicators like RSI, Mansi, maybe Bollinger Bands to look for confirmation.
So you might look for an EMA crossover and maybe see if the RSI confirms momentum.
Precisely. You're looking for multiple signals pointing the same direction to increase your confidence in a potential trade. Confluence, they call it.
Okay, that covers why they're popular. Now, let's circle back to the choice. SMA versus EMA. When would you definitely lean towards one over the other?
Generally, you'd lean towards the SMA if your main goal is analyzing longer-term trends and you want a smoother, more stable indicator. Less noise.
Like that 200-day SMA for checking the overall health of a stock trend.
Exactly. It gives you that broad, less jumpy perspective. Good for identifying major support or resistance zones over the long haul.
Okay. And when is EMA the clear choice?
EMA tends to be preferred for shorter-term trading.
Yeah.
If you want to spot potential trend changes earlier or if you're trading in faster-moving markets, the EMA's responsiveness is usually more beneficial.
So for things like day trading or swing trading, especially in maybe Forex or crypto.
Right. Those traders often use shorter EMAs, like maybe a 9-period or a 21-period, to try and catch moves quicker. The quicker reaction time is the main advantage there.
Got it. SMA for stability and long term, EMA for responsiveness and short term. Helpful rule of thumb. Now, for listeners who are thinking, okay, I want to try this out, what are some practical first steps?
Yeah, the source material gives some good pointers. First, just start simple. Don't overcomplicate it.
Good advice for anything, really.
Definitely. Maybe pull up a chart of a stock, like, say, TCS or Infosys if you're in India, or Apple or Google if you're elsewhere, and just plot a 50-day and a 200-day SMA on it. See how they track the big moves?
Just observe first.
Yeah. Then maybe add a 12-day and a 26-day EMA. See how much closer they hug the price, how they react quicker. Just get a feel for them visually.
And people don't need fancy software for this, right?
Not at all. There are tons of great free charting tools online. TradingView is very popular. Yahoo Finance has charts. Your broker's platform, like Thinkorswim, probably has them. Easy to add MAs.
Okay, so observe, use free tools. What about practicing spotting signals?
Yeah, once you've got them plotted, look for those crossovers we talked about. See when the, say, 20-day MA crosses the 50-day MA. Watch what happens to the price afterwards. Does it seem to lead to a move?
But crucially, remember the limitations.
It's absolutely crucial. Remember, MAs lag price. They show you what has happened, not necessarily what will happen, especially the SMA.
So they can be slow on reversals.
They can be. And they work best in trending markets. If the price is just bouncing around sideways, MAs can give a lot of confusing false signals, cross back and forth meaninglessly.
So don't bet the farm on just an MA signal.
Please don't. Always look for confirmation from other indicators or analysis. Use them as part of a toolkit, not a magic bullet.
Makes sense. And maybe practice without real money first.
Highly recommended. Most online brokers offer demo or paper trading accounts. Like eToro or MetaTrader platforms often have this. You trade with virtual money but see real market prices. It's the best way to practice using MAs, testing strategies, without any financial risk. Learn by doing.
Great tip. Okay, let's try to picture this in action quickly. Say, back to Infosys stock. How might the long-term SMAs look?
Right. On a daily Infosys chart, if you saw the 50-day SMA cross up through the 200-day SMA, that's the golden cross people talk about, that would historically be seen as a strong bullish signal for the longer term.
A potential sign of a major uptrend starting or continuing.
Potentially, yes. Conversely, if the price fell decisively below the 200-day SMA and stayed there, with the 200-day sloping down, that's often seen as a long-term bearish sign.
And for shorter-term Infosys trades.
Then you'd maybe focus on the 12-day and 26-day EMAs. Look for crossovers between those, or price crossing above or below the faster EMA for quicker potential entry or exit points.
Okay. What about a different market, like crypto, say Bitcoin on a 4-hour chart? Things move fast there.
Yeah, for something like Bitcoin on a shorter time frame like 4 hours, traders might use even faster EMAs, maybe a 9 period and a 21 period.
And a cross of the 9 EMA above the 21 EMA could be a short-term buy signal.
Could be interpreted that way, yes, for a potential quick upward move. But equally important, if you see those EMAs just tangling up, crossing back and forth constantly while the price goes nowhere.
That's the choppy, sideways market warning.
Exactly. That tells you that MA crossover signals probably aren't reliable right then, and you might want to wait for a clearer trend to emerge or use different tools.
Right, context is everything. So, okay, wrapping this up. Our deep dive today really showed that moving averages, both SMA and EMA, are like fundamental building blocks for technical analysis.
They really are. They're simple, they're versatile across markets and times, and they're just so widely used for spotting trends and getting potential trade ideas.
That simplicity and usefulness seem key to why they're such staples in a trader's toolkit.
I think so. And the best way to really get them is to just, play around, use those free charting tools, put them on different charts, different time frames, and just watch how they behave. It's a great way to start understanding market flow.
Definitely. So here's a final thought to leave you with. We've talked about SMAs and EMAs, short-term and long-term. How might you get creative? What if you combined, say, a really fast EMA with a really slow SMA on the same chart? Or what if you applied a moving average not just to price, but maybe to an indicator like volume or RSI itself? Could layering these tools in different ways give you even deeper insights? Something to think about how this basic knowledge can be a stepping stone.